Patrick, how are we this morning?
Awesome. How are you doing, Ryan?
Good. I'm super pumped to have this conversation. You and I've gotten to know each other over the last few years, and I really enjoyed the interview that you and Nick did. I think it was probably a couple years ago, talking about the capital gap and the mismatching of capital. And you've just really taken this theme of, really helping people understand, right in line with what we talk about a lot, is how to view and run the company like a financial asset. Exactly. And you just have a new book. And so for the people listening, and I threw it out there.
It's funny how the world works.
And so why don't you just, for the people that have not listened to that episode, maybe just give us a little bit of your background. And, and I think it's very intriguing too, when you're given that background, Patrick, of like why you are doing what you're doing now because of, the experience that you had prior to starting Hill Capital. So with that, I'll just turn it over to you to give us a little bit of an overview.
Sure. Well, my background is all in finance, and it really started with a love of understanding why things are valued the way they are. So I was probably like a typical kid, or somewhat of a typical kid, where collecting something for me was baseball cards and trading cards and so forth. And I was always intrigued why these things are valued and why they're valued differently. And so that always really stuck with me. And I've got the picture right here. It's right on my LinkedIn profile, but there's a picture of my cousin Chad and I having a lemonade stand. And I've
get proof it's not some made up story. Like I actually did it.
Exactly. It's real glass thing. My mom's handwriting is on the back. But my grandfather, who's an entrepreneur, made this sign. By the way, he didn't use the term entrepreneur ever, which is, I think, interesting. I think entrepreneurship is kind of something.
Is it more new than I would have thought, actually?
Yeah, I mean, they made a living, right? He owned a drive-in and so forth. But anyways, he made this sign, and I tell the story. It's like we were selling lemonade for 10 cents. But why did we sell lemonade for 10 cents and somebody else down the street sold lemonade for 5 cents or 25 cents? And so there's something in my DNA that has always found that fascinating. And so the common thread throughout my career is that I have done investment banking and M&A advisory, fairness opinions. I've always found it extremely interesting on capital transactions, why some companies are able to raise money and some are not. And then you unpack it further and like, why are some companies able to raise money at a small valuation, some raise money at a high valuation. And the catalyst for Hill Capital, first and foremost, what you were referring to as the capital gap, really came from that conversation of why are some companies able to raise money and some are not in the private markets, which, by the way, also happens in the public markets, but we'll focus on the private markets. And so the founders of Hill Capital, we came together and just said, you know what, we want to put together a fund that really addresses that capital gap. Fast forward a few years, we've successfully been investing in businesses as Hill Capital Corporation. And then the pandemic hit, and I'm in Entrepreneurs Organization EO, and one of my forum mates had written a book, and he knew I wanted to get my life's work out into the world. And so he had shared some experiences with his book and the process. And so when the pandemic hit, I jumped on the opportunity. I started to outline my life's work and the things that are near and dear to my heart, and thus birthed the book, Breakout Valuation. And the work has become much more impactful and important to me than I ever would have dreamed. And so It's really fun to get this out there and now have the opportunity to talk with you about it.
That's awesome, Patrick. And we're going to get into some of the concepts that you've unpacked in the book. And just a small comment about it is like what I found very, very intriguing about the book, Patrick, is that there's a lot of, the flood of books about valuations and value growth and exits over the last 5-6 years in kind of anticipation of the baby boomer boom, like tsunami is, there's a lot. However, you took more of the financial lens, but also talking about valuations, value growth, which is very much kind of in the thread and the needle that we have been talking about a lot. Before we get into some of the concepts of the book, I want to talk about, your definition of the capital gap. And because I think about even entrepreneurs, Patrick, that you and I talk to all the time, and we talk about capital, like what is it? Well, it's obviously funds that have a purpose, right? And so what is, people talk about the cost of capital. And I know you talk about that in the book too, but like let's maybe your definition of the capital gap and why is that such a passion of yours?
The capital gap, simply defined, is anything in between traditional banking, what one would think of as a bank, but it's any financial institution, credit union, so on and so forth, but any traditional lending product, and venture capital, angel capital.
Mm-hmm.
That's where it gaps out. And in the book, we talk about this because we could also simply think about this as like a cost of money, but a bank needs assets and it's very cheap money. And then all of a sudden you leapfrog to angel venture capital that are taking pure equity risk, and they need a massive potential return for the risk that they're taking. That's where the gap happens. So it happens to, I would argue, 90, 95% of private businesses are in the capital gap. They need money beyond what they can get from the bank, but their business model, their economic engine doesn't justify or can't potentially provide the minimum 10x and 100x return that a venture fund needs to buy equity into that business. And so when you've got these nice, beautiful businesses on Main Street that are selling baby products and doing other things, where do they get money beyond the bank? Where do they get cash to build their business and to build their magnetic vision? And so that was really the driving force of Hill Capital Corporation, and that is the capital gap that we see and that we address.
And you have a wonderful graphic actually in your book. I have it actually saved about like the different like inside that gap where you have like traditional banks and then you have mezz financing and higher interest rates where there's as the risk gets up.
Yes. And so I think for the purposes of the audience, I'm trying to kind of keep it simple on the capital gap, but it gets more detailed, right? Because you get from like a bank and you do have alternative lenders that can do other things, and the online lenders these days that are more that are internet based and so forth, they have a new skin, a new user interface, but at the end of the day, behind the scenes, they're doing the same thing. They need some collateral, some guarantees and so forth, but sure, they can push the envelope a little more where instead of 50 grand, they might be able to put in 100, 200 grand or something like that because they've got some algorithms, but at the end of the day, they get gapped out as well. So there's a lot of nuances to the capital gap, and it is really fun to see over the last 10 years that day after day there gets to be more and more I don't know, solutions are the right word, but yeah, solutions.
I think solution, people are meeting the gap, right?
People are addressing it. Yeah. And I'm all for it. And that's why I love talking about it, because it's a $1 trillion problem. I mean, it's massive.
I promise we won't go down this right now, this rabbit hole, but like there's a book, Patrick, I read over the summer called Between Debt and the Devil. And it was the old ECB central banker, I think, that wrote it. And interesting themes behind it, where essentially, and again, no knock to the commercial banking industry or the venture capital or everybody in between. It's kind of just this issue that you're talking about. And the macro issue, he's like real estate, traditional banks over the last 30 years since the 70s, essentially with the decoupling and then more of the fiat industry or fiat money we're like 85% of the banks just loan against real estate now.
Right. Oh, very much so. And we see
versus the cash flow. Like when we talk about, like, if you think about the internet companies, Patrick, you're talking about, like, it's a USB drive, right? Exactly. And that's it.
Right. And it is, you're exactly right. It's no knock against them. We could go on for a long time about why and how it got to be the way it got to be. I'm a student of, I think it's super fascinating, but there's nothing wrong with it. If a bank is doing commercial lending and it's real estate heavy, that is what it is. But that's why in the book and so forth, we talk about, like, don't assume, don't let one no stop you. The name of the game in private capital formation is it's a numbers game. You have to have a lot of conversations. There are investors out there for every business, I will argue. But unfortunately, for some businesses, it takes hundreds of conversations. And for businesses, it only takes a couple of conversations. But there is money out there for everyone. It's just highly
fragmented or and opaque.
Yeah, there is no one-stop shop or any of that type of stuff. And so one has to have a lot of conversations and to figure it out. And so that's what was inspiring for the book and why it became so much more important to my life's work than I ever dreamed of, because I really took the time over the last 30 months to really just reflect and try to put into really plain English where capital is and how it can be accessed, and then a framework to how to think about it. And it's to make it more approachable for entrepreneurs.
So I know we're gonna unpack some of the concepts in the book, but I'm curious before we do that. So a couple definitions I'd love for you to kind of level set us with is what would be like the maybe an example of a good capital match with a company and the right kind of capital, and what would be like the kind of characteristics of it, and what would be the outcome of it?
Great question. So we talk about capital matching a bit in the book, and a great example is, so the idea of capital matching is to make sure the money that comes in the business, any external capital comes into the business, matches the needs of where the capital is going to be utilized. And so all capital needs to be paid back at some point in time. Now, if it's somebody's just selling equity, then that's going to be paid back upon a sale of a business. And rarely, sometimes maybe some of it's paid back in a dividend or something. But then anything else, if it's debt-based or has a structure to be paid back over time, like maybe a mandatorily convertible preferred stock, it will be paid back over time. But it's matching the timeline in which that capital is going to be put to work and when it can be paid back. So the case study, the great example, and I know you've talked about it on many of your podcast episodes, is when a business goes out and gets a line of credit, and then they utilize it to do things like hiring people. Now, a line of credit is not set up to do that, because a line of credit from a bank should really be paid back in 30 to 60 days. And sure, it can be outstanding for 6 months or even 12 months or whatever the case may be. But the idea,
just in case your receivables didn't come in by Wednesday for the payroll.
Bingo, exactly. That's the idea, is like, hey, we're short on payroll, for a couple days, pull down the line of credit, get the receivables in and pay back the line of credit. But the problem is when somebody starts utilizing that for long-term growth, that's where companies can get into a problem. And that's why capital matching is very important. And then also, a lot of times companies, entrepreneurs, the founders, they're not fully thinking through what they're looking to achieve with their business long term, and how external capital providers will influence that or dictate what's going to happen over time. And so a great classic example of this is an entrepreneur that may want to own their business for 15 years or 20 years or hand it over to the next generation or do an ESOP. And I know, you're an expert in ESOPs. If they sell equity to an outside party that needs to get an exit someday, the really only viable way to give them an exit someday is to sell the business for cash. And they probably have to do it within 5 to 7 years. And sure, maybe one could say 10 or 12 years, but whatever. In some period of time, the business has to be sold for cash, because nothing else is going to move the needle for an extra.
You have to give cash back. That's just that simple.
To sell the business. And that's a sad day. And I see that all the time. I mean, I've had 2 conversations already this week on founders that haven't fully understood and appreciated that. And so that's where thinking through, making sure that capital is the right match to meet the needs of the founder, the entrepreneur, and what the business needs.
Well, and I absolutely love it, Patrick, because the same thing happens with even like phantom stock plans for executives. It's like, oh crap, well now we've got this liability of $1 million on the balance sheet, but like how are they going to get it? And so it's right. This lack of like, how are you going to convert that to cash to continue going? Right. Like it's just to continue going. And, you and I, before we hit record, we were talking about like, I'm just been beating this drum now of like, I don't care about your revenue targets. Like, I mean, all joking aside, they're important. Right. But like cash flow, right. And the target equity valuation. And maybe within this context, you can explain there's this concept, or there's this, it's a real concept, but the phrase of, equity is expensive and more expensive than debt. Can you maybe tell a story within the framework of like that target equity valuation at a point in time? And what does that mean when you're talking to people and trying to describe that equity is more expensive than debt?
Yeah, let's keep this really simple. So we talk about a dollar coming in and what that will cost for that founder entrepreneur. When a dollar comes in from a bank, it costs the dollar being paid back plus 15 to 30 cents, depending on the interest rate and the timing of the loan and so forth. But rule of thumb, you put in a dollar, you have to pay back $1.30. Okay. Now, an equity investor, they put in a dollar. It may not be guaranteed as much like a bank is, but they need the opportunity to get at least $10 back. And really, they need the opportunity to get $100 back. And so this is where valuation discussions get really sticky and tricky and mind-blowing for a lot of participants that are trying to sell equity in their business, because what they haven't fully thought through and appreciate is that, okay, if I sell 10% of my company for $1 million, that means my business has to be worth at least $100 million someday for that equity investor to hit their targets. That's a massive hurdle.
Yeah, right. And
that's just $100 million. And I can make the argument, because traditional venture capital, like the big guys, they need an opportunity for that to be worth $1 billion.
It's completely, it all makes sense, Patrick. I'm just, this is so just relevant because I read the Wall Street Journal this morning, and the FTX, ridiculous bullshit is going on. And like the venture capital SoftBank, I don't know if it was SoftBank, but whoever it was, Sequoia Capital, whatever, which one of them, all of them were involved. But they gave, so if they gave $2 billion at a $32 billion valuation, just to double their money, it's got to be worth 64 billion. And if you did the 10x like you're talking about, or the 20x like a VC firm needs, it's like, who the hell was, like, going back to your point, it's a sticky point. It's all a story, right? Based on the future. You always do a really good job of describing that story and like how the money's got to come back.
The money has to come back. And again, it doesn't have to, it's not necessarily guaranteed, but a business has to have a business plan, a vision to be able to get there to justify the investor making the decision with their partners, their investment committee, to actually write the check into the business. Right. And it's a tall order, because traditional venture capital, if we rewind to many, many hundred years ago, when venture capital got started, they were funding ships that would go into the East to bring back spices and
gold, increase the gold reserves
and so forth. So, right. Well, a good chunk of the ships would sink. So what did they do?
Like legitimate. Like the story's so great.
Like, you want to talk about a real zero? Like, you got a real zero. Like, there's no insurance back then. There's nothing, right? So the idea was you would invest in several ships. You'd invest in 10, darn well, at least 5 or 6, 7 of them ain't coming home, because statistics, were not in your favor back then. But you'd get a couple of the ships that would come back would have to pay for all the others that you completely lost your money on. That's the same with venture capital. Real true venture capital, they're in the business of going big or going home. So either something's going to be worth $1 billion or it's going to be a zero. And that's the other sad conundrum for founders. And I see this so many times, especially, I'm sure it happens everywhere, but of course, in our backyard, it seems like it happens a bit, because I think we have more entrepreneurs in the Great Northern region that they've got nice business models, businesses that can be worth 20, 50, $100 million, but they're not necessarily the next $1 billion thing.
And it's maybe not even sexy to be on the cover of a magazine or something like that.
Right. But they are trained through accelerator programs and elsewhere to really build up an awesome story. So they get lucky or whatever, and they convince some VCs to put in some money, and then all of a sudden a couple of years tick by and they realize what's happened. And what happens is that either they're gonna be high growth and achieve some milestones, or they're going to be completely shut down. And it's really sad, because there's a lot of businesses that have been shut down that 2, 3, 5, 10, 15 million in revenue. Great little businesses.
I'll take it.
But exactly. Right. Didn't meet the $100 million bogey that the VCs needed to make it happen. And so for VCs, it's easier just to shut it down and write it off and call it a complete loss. So the risk the risk reward is very bifurcated. It's for founders and external capital providers, especially VCs, and nothing wrong about it at all. I mean, many business
but
models,
it's the match. It goes back to your match. And I'm thinking, Patrick, like, I'm just thinking about like the one ship coming back with just one bucket of money that could effectively afford to pay for all the people on the ship's lives, but it didn't make it worth it for the person that funded them.
Yep. So I just like to make sure entrepreneurs are aware of and fully understand that, because get back to our conversation, it is about the capital matching and so forth. And the VCs want this, and the angel investors, they want it and need it too, because they don't want to fund something where all of a sudden, the entrepreneur wakes up and be like, well, golly gee, I actually want a lifestyle business and to run this $5 million business for the next 20 years. Like, ooh, not a good day.
You're halfway through the ocean. Sorry.
Right. So that's why it's super important to just raise awareness and help people understand that there are options. And yes, it takes more time, but these things do need to be thought through, because anytime somebody brings in external capital, debt or equity, anything in between, they have fiduciary duties to be guardians of that capital and to work as hard as they can to provide a return on it.
So let's go into the book of your definition of breakout valuation, and even the like how to finance your future strategy. I love just the undertone or the under phrase of that too. So what is your definition? What's the story behind the title?
Sure. Breakout valuation is all about getting paid today or having value today based on what the business can do in the future. And so that's the idea of a magnetic vision in particular for founders to be able to speak to what a business can achieve over time and having that value realized today. And it's not to say necessarily that they need to sell the business, but it's the mindset. It's the understanding of what the business is worth based on what it can achieve over the future to give them the guidelines and the guardrails to achieve what they're looking to achieve long term. And they may decide to do that on their own, or they may decide to bring in capital partners to help them get there. But it's that mindset of what the business can do in the future. Because that's really the core to all valuation. And that's the difference between somebody getting a massive, I know in several of your previous podcasts, people talking about a premium valuation and the gentleman that were talking about brands and so forth. But that's why big valuations happen, is when somebody can have a really strong vision of the future in the architecture and the design today to support getting to that future.
Ooh, I love how you just worded that, the vision, but then the architect to get there.
Yes.
I mean, it's that, I really like that, because I mean, because either way you can have the vision, but then if you don't have the architect, it breaks down, right?
You got to have the foundation. You got to have the design in place, and nobody's perfect, right? Like this is a squish ball for every business, even the biggest businesses. Everybody's always working on business design and making the business better. Now, of course, in earlier stage business, the more work they have to do. But everybody, this is constant. Like in a lot of your podcasts, you're always talking about things like receivables, right? Like getting paid earlier. Like that's an ongoing, never stops, never perfect. You can never be paid fast enough. You can never design the business enough to get paid, before, cash in, before cash goes out. It's always
unless your insurance and your Warren Buffett back, many decades ago that saw the float.
There are business models that are really good in this world, without a doubt, but that's why they're worth a lot. But
so let's talk about, like, you got the circle when you talk about the different components, and we're obviously not going to go into all of them, but like you got quite a few that I really enjoy. But I don't know if there's a couple that you want to pick out as far as like what are the like practical ways to actually achieve that breakout valuation. I mean, is there one in particular or a couple?
Yeah, I would love to talk about one in particular, but just to recap that web that's in the book is an idea of the 9 components of breakout valuation to kind of give a framework for entrepreneurs to say, okay, where am I in all of these? And are there some things that I should be focused on more than others? And those 9 components are confidence, vision, curiosity, people, communications, cash management, financial forecast. And now it gets into more of the strategy. The last 2 is capital strategy and business design. So it does build. The one that is the common thread with all of them that's important. I mean, they're all important and they're all interconnected, thus the web. But the one that I think is easiest for people to start with and to understand is the idea of vision. And we call it a magnetic vision. And it's the idea that the business owner really needs to articulate what the business can do in the future, but not only do that, but do it in a way that attracts other people to the vision, thus magnetic, attracting people to it. Now, who are those people? It's internal and external. Employees, it's stakeholders, it's shareholders, it's external, lenders, potential investors, vendors, other people on the outside that want to be attracted to it. Because what's really fascinating about a magnetic vision and thus a valuable business is you think about when people talk about people and culture and vendor relationships, there's a lot of these operations discussions in how to make businesses better. Well, here's a really quick and easy, I shouldn't say easy, but here's an easier way to go about better relationships. When one has a magnetic vision and can attract people to the business, who wants to work with a valuable business? Everybody. Vendors want to work with a business that's worth more because they know that that partner is more stable. Employees are more excited about a business that's growing and is valuable and can become more valuable. It just helps across the board. And so that's why we talk about these components and why it is important for entrepreneurs to kind of understand the scope of why valuation is important to them today, irregardless of whether they are going to ever sell the business.
Right, and it goes back to your lemonade stand and your first story. I've actually realized that that's my common thread too, Patrick. Where it's about understanding valuations, because then you can figure out how to grow it and sell it, whatever it is. Pokemon cards or baseball cards or real estate or companies. It's about understanding that value. And the one thing that I continuously see, Patrick, which I think you and I have this also the common thread, is that I don't know what percentage I would put it to is 80% of entrepreneurs I know that can tell one hell of a story of where they've been, where they are, where they're going. So I see a lot of people that do have a vision. It might not always be magnetic, and there's probably a spectrum of the enthusiasm that people have with their vision, but then you go, and then this is what I've been saying a lot this last half a year is prove it.
Right.
You know what I mean? That goes back to then your infrastructure side, where there's so many people with a good idea and a good vision, but they don't understand the capital. They don't understand the infrastructure.
Exactly right. That's why no one of these things can just hang out there on its own. There is no silver bullet. It's all a multifaceted, I don't want to say a problem, but it's all a multifaceted set of solutions. It's a machine. It's a complex engine. And all the components need to be there. Now, some components can be stronger than others. That's completely fine. But all the pieces need to be there. That's why it was interesting, because the original book was really going to be kind of I love the idea of entrepreneurial finance. But when we started the conversation, you talk about, well, there's no shortage of books and so forth. And that's exactly right. But they're all extremely wonky, and 99% of entrepreneurs are never going to read a book on finance or valuation because it all gets way too nerdy on the details.
All I have to do is put Patrick in one of my presentations. Well, in the main presentation I do, when I get to principle number 4 about growing value, and then I get to the value driver of finance, and I pull up, it's truly a freaking picture. A picture of the 3 financial statements and how they work together, and I can already see people going, "Oh shit, where are we going here?"
Right. Well, exactly, because literally their brain turns off. And I think about the entrepreneur who makes these tiles, and she's one of the most dynamic entrepreneurs ever. She's an artist, right? She loves her work and what she does. Now she knows the financials are important. She does her best, but she doesn't want to, she doesn't want to go to an MBA course.
She doesn't want to talk about it.
That's where I when I was writing the book, I was just okay, how do we put this in plain English as much as possible to make it approachable and give people the tools that excite them and help them understand some of the things that they can control that cause value, that they can chip away and work on, and then they can backfill into all the other things and get into more details on financial forecasting and cash management and all that, but at least they've got the framework in which to work and to work with partners like Arcona and others so that they can help dictate, where the business is going. But that's why I love to start with kind of tying back to magnetic vision. Without a doubt, like a vision just can't hang out there on its own. But without the vision of the founder, it's nearly impossible for employees or service providers to really help or do anything for that founder if there's no vision at play. Because, like, okay, what are we forecasting to? So other people,
I love what are we forecasting to, not just a top line revenue number.
Yeah, like so if they've got that vision and they can kind of articulate, it's like, yeah, I want to open up another shop and I want to do more e-commerce and I want to, and I see a day when this is happening, so forth. Now other people can help them. Mm-hmm. So that's
are you familiar with Dan Martell?
What's that?
Are you familiar with Dan Martell at all?
Years ago I was. I haven't read his work in a while.
He's still doing a bunch of stuff in the SaaS world, but I was on the show like a year or so ago, Patrick, and
really a marketer.
And he said the entrepreneur's vision has to be big enough to fit everybody else inside. That's how he worded it. I was like, oh,
brilliant. I love it.
Yeah, I was just like, to your point, because if it's, hey, we're going to have one shop and like you can quickly as an employee go, well, that's just two people and you don't need me and you don't like, so like to your point, all of the vendors, all the people, all the things have to fit inside of that in order for it to all be possible. But then to go into like, when you think about your multi-decade career in finance and entrepreneurship and business, and especially now when you're looking to deploy capital for a return, when you, and I don't know if this, I'm thinking about the lens of how I want to tackle this book too, is like, you're going to then, so let's say you find me, I've got the magnetic vision. What is your process to then understand whether I might have the opportunity to have a breakout valuation? So like, you're probably using some of the framework that you have in the book, but like, how are you going into then the discussions with me of like the prove it kind of concept? Or like, what are some of the components?
Well, a lot of it is for us this is where we're getting into in the book about, cash management and financial forecast, and to a lesser degree with entrepreneurs' capital strategy, because we can help quite a bit with that. But when we're meeting with entrepreneurs, it's really understanding kind of like their baseline and where they're at today and where they want to get to. And we've seen it across the board where they've got a professional full-time CFO that's very detailed. And we've seen and we've invested in entrepreneurs that don't have anything close to that. They've got the vision, they've got their current financials, but they really don't have much of a forecast. But we can help, we as Hill Capital can help kind of piece some of these together. So for us, we're really underwriting the entrepreneur, okay, that team, because a lot of it in private capital, it's very much people based. Mm-hmm. The business plan only does so much. It's going to be the people that are going to show up day in and day out. Are they going to work towards that vision and to make it happen? Mm-hmm. That's what we're constantly looking for. And so
you're not discounting them necessarily because they don't have those financials, because that's kind of that's part of your, but like some other investor would immediately stop.
Well, I mean, especially if they've got a learning mindset, right? Like if they've got an open mind and a learning mindset, and they may have some advisors and they're like, hey, we would like, to surround ourselves with more people in the community that can help out. Like that's just music to our ears. Mm-hmm. Not because we don't go in and dictate any strategy. I'll just say that with Hill Capital, mm-hmm, but we help surround the business with community, because the one thing is for certain is that every business, no matter how great it looks like on the front end, they can have sophisticated financials with the CFO, but problems are going to arise for every business. And it's about the mindset, and it's about the people, and it's about the team and how they're using community to get to where they want to be. That's what we're thinking through underwriting and investing and supporting these businesses. Because I've actually got case studies on both sides of that equation. I've got case studies where the financials were great, the team around the financials was great, and they hit bumps and they didn't utilize community, and it was a way tougher road than it needed to be. And I've got the flip side where, they had a vision. They have some, stuff in QuickBooks, which was a bit of a mess. If just not a flat out mess, it'd be a flat out mess for you.
Well, they had QuickBooks, so I'll give them some credit.
Right, yeah, right, exactly. So it was beyond a spreadsheet. I'll give them that. But they danced through COVID better than most others because of the mindset of the founders, the team, and they were leaning on people in the community and getting help when they need it the most. So
it's so aligned with the conscious capitalism theme that I just continue to love.
I love your podcast on that. And I love, yes.
When you think about it, I mean, it's so aligned with everything you're talking about too, because like to take it a step further, like when you have an issue, especially like, I mean, COVID, or even right now when cash dries up because it's sitting in your vendors, your clients' bank accounts, are they willing to work with you? Because you still need to pay payroll, right? And good people will. It depends on how you treated them.
Yes, that's why it's like the business plan and the financials. I mean, that's why I love the idea of algorithmic, capital being available. I think there's some element of that's interesting. There's a bunch of business models that have come up around that, but at the end of the day, it's about the people, and it's stuff that's not going to be quantified in a software algorithm. Because are they going to show up and work through these things?
So in your book, go ahead.
Yeah.
I was going to say, so in the book you've got, I don't know if it was capital traps or valuation traps, but like, I know there's some kind of like things to look out for that you see like that are kind of common issues that people have while trying to pursue that goal. Anything in particular that you wanted to bring up?
Yeah, there's a few traps, and it's kind of going on the theme of mindset. A lot of it is the mindset. We talk about like walls, and a lot of times those walls are illusions. But one of the big common traps is that they think that entrepreneurs will think that I'm not going to raise money because I don't need the money. Like my business model is such where I don't need additional money. And at some point they do. Every business does, and that's why I talk about in the book. Even Warren Buffett and Berkshire Hathaway has issued tens of billions of dollars in debt. Why would they do that when they literally have hundreds billion dollars plus of cash and completely liquid securities? Well, they do that because he's building a fortress. All businesses need to be raising capital and developing relationships with external capital providers. So a lot of it is a mindset trap where people fall and be like, oh, I don't. And another one, like we talked about early in the conversation, is the idea that, hey, I'm not bankable, because I met a banker at an event and they just basically said, hey, we couldn't lend to you. And they take that as getting a no from all, 3,000 banks.
From the finance world in general, right?
Finance world, yeah, exactly right. And so that's where the trap is set, where they are self-limited in their ability to become a bankable company, probably much faster than they could otherwise be. So that's why we're encouraging people to just be aware of these things and to think through, what are these walls or conceptions that you have in your mind, and are they really valid? And the vast majority of them are nowhere near valid. And so that's why I would kind of bring up, like, think through this and work through this.
It's so interesting. The story you're just telling me made me think of this. I mean, I just got done with our group training calls yesterday, and one guy's got like $15 million in debt. And this other gal is like, oh my God, I don't have anything even on my credit cards. And so like, I mean, you see that spread, and it's really interesting because like how many times you hear like they're just debt adverse. I mean, there's a disproportionate amount of people that are willing to take on debt with no thought about it. But then there's the people obviously that, for personal reasons, historical experience reasons, say no debt at all. So I want this is a two-part comment, Patrick, because I want your thoughts on that. But then what I would see, like, and this goes into the cost of capital and equity, that person that's debt adverse would rather just give someone 30% of their company.
Right. Yeah. And
like, kind of like
they traded the future, and it's going to be a sad day when they go to sell the business someday, or those people that have equity be like, hey, I want some cash back for my stock. They don't realize how they traded their future when they sell equity. Yeah, in the book, I talk about people can make debt look like equity and equity look like debt. And so if anybody is equity or debt adverse, I highly recommend they just wipe that vocabulary, wipe that from their brains. Because it is about capital matching. It is about, like, when people bring in external capital, what are the hooks? What are the expectations that come with it? Now, some are going to be legal expectations that are.
I was going to say, yeah, are you going to get into the hooks? Because I like how you said that.
Yeah, I mean, some of it, it's just the agreement, right? Of like, okay, this is how the investment or the loan's going to be paid back, and so on and so forth. But what's interesting is the stuff that's not on paper. It's the other expectations that are set by those lenders or investors. You see this a lot of times with angel investing, where people come in and say, I'll put in 25 grand and, buy the stock. But then there's this expectation that they're going to hire him as a consultant, or they're going to,
listen to him all the time.
Son come and work for them as an intern, or they're going to take their phone calls all the time. There's all these other things that go with it as well. And so those are soft, those are tough, but they are quantifiable. But a lot of times it just comes down to communications to make sure with that external capital provider, okay, what are your expectations? What does this relationship look like? How have you worked with others? In empowering that entrepreneur to do as much due diligence on the capital provider as the capital provider is going to do on the entrepreneur in their business.
Well, I think you just touched on something that you've kind of alluded to it already in this conversation, but like the entrepreneur with the magnetic vision and a plan has all the right in the world to do due diligence on every one of these people, because the capital needs a return, so it needs a home. So and I don't know what it is inside of the mindset. I mean, Patrick, the reason I'm so damn passionate about this shit is because 10 years ago, we were financing our receivables while turning around a $20 million business, and the bank legitimately was my mortal enemy. That guy would have stolen my employees' children. I swear to God. and what happens is and it's taken me damn near 10 years to figure out holy shit, it's this asymmetry of knowledge of I didn't know any of the shit he was talking about. And then you're beholden to the person that may or may not allow you to provide for everybody. And so it's that power dynamics. And I know that this is not for all bankers. I'm just saying that this was my mindset from my personal experiences. Right. But I do see that there's a more of a theme out there than I would have anticipated of other entrepreneurs they were the engineer, the artist, the whatever, that doesn't know what a cash conversion cycle is and goes, I have an idea and I need a paycheck and I wanted to make it worth it over time. So there's this asymmetry of knowledge that becomes fearful. So they that's what allows the one person to say no to them to accept it as truth. So do you see this as well? Again, I'm projecting my own personal experience. I know there's really good bankers out there and there's really smart entrepreneurs that understand finance, but I've seen that it's usually.
Well, first and foremost, that's why your work is so important in what we're doing here today, but it's all about leveling the playing field and empowering entrepreneurs with the knowledge and the tools to be successful. So I see fear constantly in private capital. And the classic case of fear with private capital is an earlier stage business that needs to raise $1 million or a couple $1 million in usually equity to get their business off the ground. So traditional startup. Well, oftentimes the vast majority of them, they're so darn happy and feel so lucky that they even get to have a conversation with somebody. Yep. And so they come in and they're giving the presentation. They want to try to be buttoned up and so forth. And they're very reluctant to asking questions because they want to kiss their feet. And they want to do anything that will support that person to make an investment in their business.
And don't take it away. Don't take the opportunity away. It's the whole life is sitting right in front of them.
So they think they're going to offend that VC investor by asking them questions, and especially questions that are a bit more pointed about who else have you invested in? What does that relationship look like? What has worked well for you? What has not worked well for you? How much money are you investing? Who are the investors in your funds?
I know,
is this institutional money or individuals? So all of these are valid questions that I'm always happy to answer. And by the way, big green flags go off for me when entrepreneurs come in and ask us these questions, because one, we're good for you that you're asking these questions because they are important questions and we're more than happy to answer them. But 99% of entrepreneurs are way too petrified to even ask a fraction of those questions.
And again, goes back to the work that we're both doing. And actually to I've been, harping one side of this coin for a little bit. Like, to go on the other side is like, from any investor, all the private equity firms I know, or banks or whoever, they love it. The really good ones, the good providers.
The really good ones too.
Yeah, I love the fact, because it builds the trust, right?
Well, the thing is the ones that don't like it, they have something to hide.
I know, right? It's like, right? It's so funny, Patrick. My favorite story on that is we had a client down in Arizona that called us up. They were like in the middle of this deal, due diligence with a private equity firm, and they were supposed to roll a couple $1,000,000. And then we're just like, hey, here's a list of 15 questions that you should ask them. And the PE firm, essentially, it was like the latest version of reverse due diligence, and the PE firm wouldn't answer any of the questions.
Yeah. And you just saved a lot of heartache, because it may not have happened after closing, but at some point there was going to be massive heartache if those questions weren't asked and answered. And so let's bring this to a real case that affects a lot of people, even well beyond entrepreneurs. This is how classic fraud happens. I literally know a couple of people that have sent money out to, the Saudi Arabian princes. And there's some people that I have deep respect for that I thought were quite brilliant in the world of finance.
Yeah.
And it's shocking that they even didn't take the time to stop and think through this, and then turn around and ask them questions like, how does this work? What am I, just some basic.
Officer Dave from the IRS is here and would your money. Yeah.
I mean, we had an entrepreneur that we know really well that was falling into this trap. And luckily I had talked to them beforehand, and I said, go back, email them back and ask these types of questions. And why do you need me to send $50,000 to prove I've got a bank account for you to fund your, $20 million investment or whatever, and ask some basic questions and ask for some referrals. Nothing, right? Like you said with that example you had, got nothing back. And they said, see, if this was real and legit, those are somewhat simple questions that they owe you before you just shuttle off 50 grand on a wire that you have no idea where it's going.
Patrick, was so much of this and I want to get into some of your concepts of that you think are kind of like the foundational building blocks of financial literacy, but so much of this is tied to just a lack of financial literacy. And I just think about how so many hours of my brain have been spent on why the hell did we get here? And I think about it how many times I've said recently, I don't know if I've told you this, legitimately financial accounting was my worst grade in college. So while Nick, your business partner, was at the library studying, I was trying to figure out how to play beer pong. All joking aside,
accounting gives me a visceral reaction. I don't like to look backwards at numbers. I'll do it enough to build a forecast. I love finance, the idea of looking forward.
I love that definition.
So, I mean, it can even be bifurcated, but everybody has their preconceived notions, the context of where they and how they grew up, and the things that they naturally love to do, and the things that they what are you good at, what are you not, the quadrants and so forth. So, I've been thinking a lot about that too, Ryan. I don't know if I have the answer, but I don't know if it's a financial literacy problem. I think if we peel back the onions a little bit, and maybe this is why I did start with things in the book like confidence and curiosity and so forth, but I think a lot of it has to do with mindset. And the mindset, like we were just talking about, because if somebody just had a mindset of being encouraged and to be able to ask questions, and especially questions of essence, and trained to just say, hey, you don't need to be smart on any of this. And as a matter of fact, you don't need to know any of it. But if you can be empowered to just ask some basic questions and have the mindset that you don't care about the risk of looking foolish or offending somebody and so on and so forth, that by itself can accomplish miracles. Matter of fact, now that I'm saying all that out loud, I think that is the crux and the core of it. Really good.
I love it. And I was just going to tee it up actually right back at you and say, and what I think actually provides that confidence and courage is community.
I love it. I love it.
Because I want to hey, Patrick, I'm going to go have this conversation with a bank that may or may not give me a loan for my future. And knowing that it's okay if they say no, and you're going to help encourage me, give me some questions to ask. I mean, it's a support system.
I love it. I love it. Yep.
So when you go like to get into financial literacy, just and I know we're getting a little bit short on time here, is that what are some of the foundational building blocks of, if you call it finance? I mean, I know you've got one of the things is forecasting, and you got different financial parts of the web. But I'm curious, like, if you were to say to someone like, hey, here are some of like the 3 to 5 key components of things that would be worth exploring as part of your first kind of thread to pull for finance, what would be some of them?
Well, let's start really simple on cash management. So we call it the cash management trifecta, but literally just knowing what you owe others, what others owe you in your current cash balance. That's the trifecta.
I love
and
it.
if you know those 3 things,
Visibility.
because then if you start to track them, maybe on a monthly basis, but even better on a weekly basis, and optimal is on a daily basis. If you know your cash balance, what others owe you and what you owe others, and you watch that, because what's going to happen for every business, those numbers are going to go up and down. And that's where, for an entrepreneur, a very simple exercise. And as they watch those numbers go up and down, and if they're dramatically fluctuating on a day-to-day and week-to-week basis, then they're going to start to be more curious to say, why is this fluctuating so much? What's happening behind the background? Oh, gosh, now I understand why my CFO keeps harping on me that, payment terms matter so much. So when I go out and win a big new contract, that I just don't roll over on that 45 days.
Yeah, I love it, man. And personal story from a client of ours who was actually on the show. He was like, yeah, man, when I was head of sales, and this is the owner, when I was head of sales, I would just be like, oh, sure, net 90 just to get a new deal. And then all of a sudden, next thing you know, this is like years later, he's like, we have no cash. And it's like, well, all of his terms were 90. He's like, oh, I understand why it's important now. And then they just quit doing that.
Well, and going back to people being afraid to offend people, it's the same thing. We recently had a company that we know really well that they won a big contract from a very big healthcare system. Now, all their other contracts were smaller healthcare systems and were very favorable on the terms. Well, this other's like the big guy.
Net 365.
Right. Like it is what it is. Well, no, not necessarily. Ask. Because if you do that deal, you might not be able to do that deal because you can't afford to service the big guy.
Well, and Patrick, what you just said too, like, I think personal experience, again, experience share, right? I will never shoot on someone.
Right. By the way, don't shut on yourself either. I learned that the other day too. It's like, don't shut on yourself either, because that's not good. So
I like that. Just do, right? So I think if people know why it's important to tell that big client, I can't accept that because I won't be able to pay payroll in 3 months. But like, it's the why that people don't know. So then they kind of roll over like, well, okay, well, it's just me being a dick. No, it's actually a legit reason. And if you explain it in a legit way, I think most people are reasonable.
Well, exactly. And that client doesn't want you to be in financial hardship either. And what is nice is that I have seen a trend where larger businesses are getting really good at working with small businesses, and they understand there's different constraints, right? Not everybody is the Walmart and the Procter & Gamble's of the world that are, playing working capital games. And so the good customers, the good relationships, they'll get it and understand it. And I think it's like what we were talking about earlier. I think out of the gates, there'll be much deeper respect with everybody involved if they have the conversation. They're realistic about what can be done and how it can be done, so it doesn't put either party in a bad spot.
Community, right? I mean, it's the stakeholders, the conscious capitalism. It all matters there's a reason it matters, right?
Yeah. Curiosity, like think about these things, talk about it. Don't be afraid to talk about it. Yeah.
Love it, Patrick. So a couple final questions for you. What's your hope for the book? Like, what's the dent that how would you define success if you were to wake up in 2030 and the book's been out for this long?
Well, my magnetic vision is that this book is in the hands or aware of, by nearly every entrepreneur out there, especially within, the United States and North America. I just want to make the content available to everybody. So I've got some pretty big personal goals on getting the book out there. But look, when I wrote this book, it was all done the mindset as if even if we sell 100 copies, that's all matters, because if I can help the life of one entrepreneur with the content, for me, that news moves the needle big time. But the good news is we've sold way more than 100 copies, so well past that initial goal. But my goal is to help update the thinking of entrepreneurs to really empower them. So I would love to have most people be aware of this in 7 to 10 years.
Love it, man. Then 2 final questions. What is the word intentional
By the way, it starts here. That's what's awesome.
We're going to get the link out. That's the second question. We're going to get the link out. We're going to get everybody out pushing out the word too. Well, why don't you just give it, what's the best place to find you, your company, the book?
Yes. So the best way to find me, I'm an avid LinkedIn user, so I'm easy to find on LinkedIn. Breakoutvaluation.com, and people feel free to email me directly, patrick@breakoutvaluation.com. We'd love to hear any stories or questions that people have. We do our best to communicate with all, especially with all entrepreneurs. That's for sure.
Love it, man. And then the last question is, what does the word intentional mean for you?
Intentional to me means on purpose and thoughtful. Really being conscious and thoughtful about what, where, how, why.
Love it, man. Patrick, thanks so much for coming on the show and sharing your story.
Thank you, Ryan. It's great to be here today, and I love the opportunity to talk about building value for entrepreneurs. It's been great.